Good morning everyone, I'm Ken, financial analyst from Regain Capital, and welcome to our morning market briefing on the 13th of November, Friday. So as usual in our market briefing, we will cover three parts, namely the fundamentals, the news release, and the technical analysis. So without further ado, let's start off with the fundamentals. When we take a look at yesterday's market movement, we can see gold rebounding by 0.62%. The pair of GBP US dollar fell by 0.78%. The dollar index retraced lower by 0.04%, and oil falling by 1.17%. So let's get into details with the headlines of today. First off, we have oil, where we can see yesterday's inventory build up and fears of a virus had pressured the oil lower. Now, just as oil bulls were cheering on a vaccine news earlier this week, the commodity is now pressured back below its key support level near the 41.5, where we'll cover more on the technical later on. So Thursday's crude sell-off came amid the rising US inventory levels of up to 4 million barrels as reported by the Energy Information Administration, where economists expect a drawdown of nearly 1 million barrels. Furthermore, the US reported more than 100,000 new COVID-19 infections for the 9th straight day, with yesterday's figure reaching a new daily record high at more than 140,000. So overall, we can see that the temporary boost from the vaccine has now diminished, and currently selling pressure on the commodity is coming back to the market. Furthermore, with the rising infections would possibly trigger and further jeopardize oil demands in the near term, thus causing yesterday's movement and also the fall in oil prices. So instruments involved here would be crude oil itself and also the Canadian dollar, where Canada's economy depends highly on the prices of crude oil. So moving on, we have on the pound, where we can see pound pressured by a gloomy economic outlook ahead. So for major economies such as the UK and also the US or the European Union, their economy typically expand during the winter holiday period. However, the situation for the UK will be slightly different this year as London remains in lockdown. Now, analysts are suggesting that the restrictions and the lockdown within the country would definitely jeopardize businesses while potentially causing an economic recession for the UK. Now, furthermore, the pound is also threatened by Brexit talks, where failure to reach a deal by the end of the month could trigger a major sell-off for the currency. So we can say that the time is also running out for a Brexit deal, with less than 3 weeks for both sides to compromise, and still there's no updates from either side on the progress of Brexit, thus causing the pessimism in the market and also supporting yesterday's sell-off for the pound. So instruments involved here would be pound itself. So that's all for the fundamentals. Moving on, let's take a look at the news release. So please take note, time stated here is at GMT plus 8. So today we only have one important data, which is from the US at 9:30 PM. That is the producer price index, which is also an inflation measuring tool used by the central bank to gauge inflation expansion or contraction from the producer side. So overall, it is expected to fall from previous month of 0.4% to 0.2%. Any reading lower than the forecasted value would exert pressure on the US dollar. So that's all for the news release. Moving on, let's take a look at the technicals. So here's an overview of instruments to be covered. First off, the pair of GBP JPY H4 showing a downtrend, the Euro GBP H4 showing an uptrend, Euro Canadian dollar in its H4 chart showing an uptrend, and for the oil in its H4 chart still in an uptrend. So let's get into further details with the chart analysis, starting with the GBP JPY. So constructing a Fibonacci from the previous high here towards the low, and also determining a strong resistance close to the psychological level of 140. And we can see that yesterday's trading has actually led the pair lower following the first rejection from the resistance of 140, breaking below 61.8 Fibonacci, and now the 50.0 Fibonacci near 138. So MACD signaling a strong bearish momentum suggests the pair to extend lower towards the 38.2 Fibonacci. So investors can take this opportunity to enter to consider short positions at the current level 137.7. Stop loss should be placed 30 pips and above the 50.0 Fibonacci at 138, and a take profit can be targeted just slightly above the 38.2 Fibonacci near 137. However, if the pair fails to extend its losses and closes back above the 50.0, please take note that overall trend in terms of the daily is still looking towards the upside, so there is still potential for the pair to reverse and continue its trading within an uptrend. Next, for the pair of EURGBP, so constructing the Fibonacci from the previous high over here towards the low, we have obtained levels as such, and if we're looking into the daily chart, we can see a nice slightly pin bar formation where we can see a long shadow right below, just all the way towards the crucial support level at 0.8870, and has actually rebounded, and yesterday's candle is showing a strong bullish candle. So from the H4, we can say that the pair might be changing its trend back towards an uptrend. So overall, we can still construct a downtrend line where breakout confirmation would require slightly above the 50.0 Fibonacci near 0.9060. So overall, cautious investors are advised to wait for the breakout above the downward trend line before entering into long-term long positions for the pair. But at the moment, following the breakout above the 38.2 Fibonacci at 0.9020, investors can then consider long positions. Stop loss should be placed 30 pips from the level at 0.8980, and a take profit all the way towards the 50.0 Fibonacci at 0.9060. However, if the pair fails to break above the 38.2 Fibonacci, aggressive investors can then consider short positions with a stop loss and a take profit of 30 and 50 pips respectively. Next, for the pair of EURCAD, constructing the Fibonacci also from the high towards the low, we can see that the pair is currently testing near the 50.0 Fibonacci at 1.5530. MACD showing a bullish momentum suggests the pair to extend higher after successfully breaking above the 50.0 Fibonacci, where after the breakout, cautious investors can consider long positions. Stop loss should be placed 30 pips from the level at 1.5500, and take profit targeted all the way to the 61.8 Fibonacci at 1.5580. Or a second target would be the resistance close to the 1.5660. However, if the pair fails to break above the 50.0 Fibonacci, it might continue being traded within a downtrend over here, and aggressive investors can then consider entering into short positions. Stop loss should be placed 30 pips above the 50.0 at 1.5560, and take profit following the 38.2 Fibonacci as the first target and the 23.6 Fibonacci as the second target. Lastly, for crude oil in the H4 chart, now previously we have covered for that the oil has successfully broken above the crucial resistance at 41.5. However, after reaching a session high near 43.2, the commodity is now pressured back, also breaking back below this crucial resistance turn support at 41.5, and MACD is now signaling a bearish momentum. And if we were looking into the daily chart, we can see a possible pin bar formation over here, where in the daily chart it left a long shadow. And with the current fundamentals, speaking of the inventory levels and also the virus infections, the outlook for crude oil doesn't look good, as the previous breakout was depending on the news of the vaccine. So overall, we will wait for further confirmation to see where the crude oil is heading, where the next support level can be seen at 39.3. So overall, cautious investors are advised to wait for further confirmation to see whether or not the yesterday's fall in the prices is actually just technical correction, or would it signify a possible change in back to a downtrend for the commodity. So overall, we'll wait to see whether or not a breakout above the resistance 41.5 would signal that yesterday's trading was just technical correction and the crude oil might continue its trading within an uptrend, or would it break back below the support at 39.3 and head towards the previous downtrend. So at the meantime, aggressive investors can consider entering into short positions at the current level 40.9. Stop loss should be placed right above the resistance at 41.6, and a take profit can be targeted slightly above the 39.3 near 39.5. And cautious investors again are advised to wait for breakout from either side before entering into positions for the oil. So that is all for our market briefing. Please remember to follow us on our social media such as Facebook, Telegram, Twitter, as well as Instagram. And feel free to drop by our website at www.regaincapital.com to get updated on all the latest market news as well as education posts for our clients. So thank you all for listening. We'll see you next week on our market briefing, and happy trading to all.